Most people believe that building an investment portfolio is something that requires either a financial advisor managing everything for you, or hours each week studying the market, picking stocks, and watching charts. So they put it off. Or they hand it to someone else and hope for the best. Or they do nothing and leave the money sitting in a savings account earning almost nothing. Here's the truth. The most effective investment portfolio for most people is also one of the simplest. It requires about 3 funds, takes less than an hour to set up, and needs your attention roughly once a year after that. In this video, I'm going to walk you through exactly how to build it, step by step. Let's get into it. Before we get into the specific funds and numbers, 2 principles underpin everything we're going to cover. And if you understand these, every decision that follows will make sense. Principle 1. Diversification. Don't put all your eggs in one basket is the oldest financial cliché in existence, and it's a cliché because it's true. When you own a single stock, you're betting on one company. When you own 500 stocks, a bad quarter at one company barely registers. A well-diversified portfolio smooths out the volatility of any individual holding and reduces the risk that one bad outcome derails your entire financial plan. Principle 2. Keep costs low. Every dollar paid in fees is a dollar that doesn't compound. A fund charging 1% annually versus one charging 0.05% annually might sound like a trivial difference. But over 20 years on a $100,000 portfolio, that gap costs you tens of thousands of dollars in lost compounding. The investment industry has spent decades convincing people that higher fees mean better performance. The data consistently shows the opposite. Low-cost index funds outperform the majority of actively managed funds over long time periods, precisely because they're not dragging returns down with fees. Those 2 principles, diversification and low cost, are the entire foundation. Everything else is execution. The tool that delivers both diversification and low cost in a single package is an index fund. An index fund doesn't try to beat the market. It simply tracks a market index, a defined list of stocks like the S&P 500, which represents the 500 largest publicly traded companies in the United States. When you buy an S&P 500 index fund, you instantly own a tiny slice of all 500 companies. Apple, Microsoft, Johnson & Johnson, JP Morgan, all in one fund. Because index funds don't require a team of analysts picking stocks, their fees are extremely low. The expense ratio on a broad index fund at Vanguard, Fidelity, or Schwab is typically between 0.03% and 0.10% annually, often less than $1 per year on every $1,000 invested. Compare that to an actively managed mutual fund, which commonly charges 0.5% to 1.5% or more, and the performance record is clear. Over any 15 or 20-year period, the vast majority of actively managed funds underperform their benchmark index after fees. Not because the fund managers aren't smart. It's because consistent market beating is extraordinarily difficult, and high fees make the hurdle even harder to clear. Index funds are the engine. Now let's talk about which ones to use and how to combine them. The simplest effective portfolio that financial experts and long-term investors keep returning to is called the 3-fund portfolio. As the name implies, it's built from just 3 index funds, and it covers virtually the entire global investment universe. Fund 1, a U.S. total stock market index fund. This gives you exposure to essentially every publicly traded company in the United States, large, mid, and small cap stocks. At Vanguard, this is VTSAX or VTI. At Fidelity, it's FSKAX or FZROX. At Schwab, it's SWTSX. All do the same job, own the whole U.S. market at very low cost. Fund 2, an international stock market index fund. This covers stocks from developed and emerging markets outside the United States, Europe, Asia, Canada, Australia, and more. It adds geographic diversification so your portfolio isn't entirely dependent on the U.S. economy. At Vanguard, this is VXUS or VTIAX. Fidelity and Schwab offer equivalent options. Fund 3, A bond index fund. Bonds are lower risk than stocks, and they tend to hold their value or increase when stocks fall. They're the stabilizing force in your portfolio. Vanguard's BND is the most widely used option. Fidelity and Schwab offer similar alternatives. 3 funds. The entire global stock and bond market covered. That's the portfolio. Once you have the 3 funds, you need to decide how much of your money goes into each one. This is called asset allocation, and it's driven primarily by one factor: how many years until you need the money. The classic rule of thumb is to subtract your age from 110 to get your stock allocation. At 50, that's 60% in stocks. At 55, it's 55%. At 60, it's 50%. The remaining percentage goes into bonds. The logic: the closer you are to needing the money, the less time you have to recover from a significant market decline, so you shift gradually toward the steadier performance of bonds. Within your stock allocation, a common split is roughly 70 to 80% in the US fund and 20 to 30% in the international fund. So a 50-year-old with a 60% stock allocation might hold 45% in US stocks, 15% in international stocks, and 40% in bonds. These aren't rigid rules, they're starting points. Someone with a high risk tolerance, a pension providing stable retirement income, or a longer expected retirement timeline might carry a higher stock allocation than the formula suggests. Someone closer to retirement with less flexibility might prefer to be more conservative. The key is choosing an allocation you can stick with through a market downturn without panic selling. If this is making portfolio building feel more approachable than it did before, go ahead and drop a like. It helps more people find this channel. Now let's talk about where to actually hold these funds and the one maintenance task the portfolio actually needs. The funds are the what. The account type is the where. And the order matters because different account types have different tax implications. Start with your employer 401k, up to at least the full employer match. This is pre-tax money growing tax deferred, and the match is a guaranteed return on top of that. Most 401k plans offer index fund options from Vanguard, Fidelity, or Schwab. Look for the funds with the lowest expense ratios in each category. Next, contribute to an IRA or Roth IRA. These give you more fund choices than a typical 401k, and either pre-tax growth, traditional IRA, or tax-free growth on withdrawals, Roth IRA. The annual contribution limit in 2024 is $7,000, or $8,000 if you're 50 or older. If you've maxed out both and still have money to invest, a taxable brokerage account is the next step. The same 3-fund strategy applies, just without the tax advantages. Fidelity, Schwab, and Vanguard all offer straightforward brokerage accounts with no minimum balance and no trading commissions on index funds. Here's the single maintenance task the 3-fund portfolio requires: rebalance once a year. Over the course of a year, some funds will grow faster than others and throw your allocation off target. If stocks had a strong year, your stock percentage might drift from 60% to 68%. Rebalancing means selling enough of what's grown and buying enough of what's lagged to restore your original target allocation. Here's how to do it. Once a year, pick a date you'll remember, like your birthday or January 1st. Log into your investment account and check your current allocation. Compare it to your target. If any fund has drifted more than 5 percentage points from your target, rebalance. Sell the excess from the overweight fund and use the proceeds to buy more of the underweight fund. In tax-advantaged accounts like a 401k or IRA, rebalancing has no immediate tax consequence. You can buy and sell freely. In a taxable brokerage account, selling triggers a taxable event, so a more tax-efficient approach is to direct new contributions toward the underweight funds instead of selling. The entire process typically takes 15 to 30 minutes once a year. That's the full-time commitment this portfolio requires. And it's why it's genuinely low maintenance, not just described that way. Here's what building this portfolio actually looks like. Open or log into your 401k, IRA, or brokerage account. Find a U.S. total market index fund, an international index fund, and a bond index fund, all with expense ratios under 0.10%. Set your allocation based on your age and risk tolerance. Automate your contributions. Then, once a year, spend 20 minutes rebalancing. That's it. You don't need to watch the market. You don't need to pick stocks. You don't need to time anything. The strategy works precisely because it removes those decisions entirely and lets compounding do the work over time. If this channel is helping you take the complexity out of your financial life, subscribe. There's a lot more of this coming. I'll see you in the next one.